The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, folks. I'm surprised to see so many people here so early. I just hit the start button on the off chance somebody would be waiting, and the audience has been filling right up. Shout out to Milo, one of the Mid-Michigan directors. Thanks for coming tonight, sir. We appreciate you being here.
All right, go ahead. Why don't you go ahead and kick us off, Ken?
Okay, well, I'd like to welcome everybody to the June session of the Roundtable. A special thank you and hello to our Mid-Michigan folks. This is sponsored by the Mid-Michigan chapter, and Mark reminded me before we started tonight that we're approaching our 8th anniversary. We'll be doing this for 8 years in just a month or so, so join us for our birthday party. We'll make sure we let you know when that's going to be. Tonight, I'm joined by two good friends, Mark Robertson. Mark lives about 40 miles southeast of where I live, and the two of us are able to get together quite often, and we travel to chapters talking and having a great time. And Mark and I have been doing this consistently now for all 8 of those years. And Hugh has been with us most of the time when he can get away from his demanding job. He does a lot of traveling. Hugh McManus, his home base is out in Pasadena, California. So welcome this evening, Hugh. We're so glad that you were able to make it with us. The Roundtable is a program where we try to give you our very best stock ideas. And before we get started, let's go over our whatever this thing is called.
Legal Beagle.
Our Legal Beagle stuff, okay. Just remember that everything that we talk about this evening is for educational purposes only. We are not going to be recommending stocks for you to purchase. We're talking about our best ideas, and we think as members of Better Investing that any idea that you get from anybody, you should follow up with your own study and make your own decisions. We're just illustrating some of the methods we use. Most of you are now receiving reminders about these events. But if you have a friend that you think might like to come, or if your reminder is not getting to you in a consistent way because you've changed your email address, then communicate with my wife, Anna Kavula1 at Comcast.net, and she'll get the problem solved for you, or add your friends to the list if you have some people that you'd like to add to our list. She's informing 700 or 800 people outside of our chapter now about the Roundtable, and we're happy to say that many of them join us for the Roundtable, and we get those notes out pretty consistently, so we're real happy about it. If you want a copy of the slides, you can email Mark R. at manifestinvesting.com, and we do post the presentations on YouTube. The YouTube channel is the Manifest Investing Roundtable, and that channel is free. You can go and look at these things in archived fashion, and if you happen to miss one of them or two of them, you can go back and take a look at them. I was really surprised, Mark, when I checked that out about 2 years ago and found out that they were actually getting hits. And I'm looking at them recently, and I'm finding out that they're getting quite a few hits. They're getting a couple hundred hits a piece, and for something like this, that's a pretty good record of people wanting to see what we're doing. So why don't we get started, and I'll let you talk about what the prime ideas are behind the Roundtable, Mark.
Okay, well, first of all, we kind of have a standing agenda. Again, welcome to those of you that have been with us before, and a special extra big welcome to those of you who are joining us first time. Again, we try to keep this fairly informal. We are going to do 3 stock presentations that you can see there with Universal Display, Beacon Roofing, and Bristol-Myers Squibb. We're also going to challenge the portfolio a little bit, talk about some of the companies that might be considered for selling analysis. But again, we try to keep this fairly informal. With only 3 presentations, we'll probably have a little bit more time for Q&A at the end, as it says down there in point number 8. But this is kind of our standing agenda. We generally have 3 or 4, sometimes 5 stock presentations, and yes, we do have the audience vote on it after we make the presentations. Again, we've been doing this for 7 years and 11 months. The rules of engagement were no costumes, according to Ken, back in when I first approached him about this. But other than the no costumes rule, sometimes we do have hats on the cover slide. But we really are trying to share a study idea, a potential investment opportunity. And we do encourage people to bring non-core selections every once in a while. Hugh has a particularly spectacular track record with the non-core selections, companies like Amazon and Bank of America when nobody could stand banks, that sort of thing. So we do tolerate those and encourage them. We are trying to beat the Wilshire 5000 by 5 percentage points over the long term, and we do keep track. We'd also like to see the majority, hopefully 3 or 4 out of every 5 selections, basically outperforming the stock market from the time of selection. Here's our scoreboard as to how we're doing. As we approach that 8th year, we have had just phenomenal success with some of the companies in the portfolio, the Cognizants, the NetEases, just a whole variety of different companies. We do have a strong belief in all of the above investing, small, medium, and large companies. Got to have enough growth, and it's one of the primary reasons that we believe we're able to do this. Again, we're trying to beat the market by 5 percentage points. We weren't quite sure we were ever going to get there, but we always had hope. Well, we're there. We're running at about a 6 percentage point advantage to the market with an actual absolute rate of return of about 17%. Over half of our selections are beating the market. And again, that's a lofty goal. It's a stretch goal. And so if you're in an investment club and you run your club performance report and you end up anywhere in that 0 to 4% range, don't consider yourself a failure at all. That tops most mutual funds. And even if you're slightly lagging the market, stick with it. As is shown here, sometimes it takes time. Any questions or comments?
No, we're clear at the moment, Mark.
Okay, let's keep pressing on then. What we do like to share every month is the top 20 components that have contributed to that performance over time. And again, this is by size of position. That public link up at the top, even if you're not a Manifest Investing subscriber, you can get to that public link up at the top and you can see all of the selections. I believe there's about 90 active selections in the portfolio. That little legend underneath that box at the top basically gives you a scorecard about the number of times a company has been selected over these past 8 years. For example, Cognizant Technology, ticker symbol CTSH, has actually been selected by literally all of us, but mostly by Cy Lynch, 14 times. Every time a company is selected by either one of the knights, damsels, or the audience, we invest $1,000 into it as of the night of the meeting. So $14,000 has been invested in Cognizant. It is now worth $26,000. So you can go down that list and kind of decode it. You'll see a company like Amazon has, I believe, been picked twice, as you can see right here. So $2,000 invested in Amazon by virtue of Hugh is now worth $11,300. So we kind of like it when that happens. So again, going down the list, some of these are not selected quite so many times. They're more spectacular in the gains that they've made, but many household names, many core holdings that are held by many investment clubs and individual investors within our community. But we also pride ourselves in keeping an eye open for other promising opportunities that aren't necessarily on the screens at CNBC every day.
Yeah, we really do believe in the rule of 5 as well, and the rule of 5 says that one stock, no matter how great the study, that you do. It just won't perform the way you expect it to. I will point out CVS as one of the ones on this list as representing the rule of 5. That's a 10-time pick, but it's only worth $7,300 right now. So not all of these picks are spectacular, but the one right below it, the Illumina pick, that's a 4-time pick. Only 4 times, so that's $4,000, which is turned into almost $8,000, and that's what we're looking for, that 15% plus return, so we can double our money every 5 years. There's some great picks on this list, and there's a few clunkers as well, so buyer beware. Don't just buy the list. Read it, study it, and make sure you're buying something that has some potential to make you some money.
Now, Hugh, I am noticing that General Electric has been selected a few times. It's not showing up here on the top 20. Do you have any comment about that tonight?
You know, part of its core business, it's a train wreck, right?
Okay. So it's got robust room for improvement.
Yeah. It's pointing the way of its next move very clearly, day by day.
Okay. Well, it had a good day today, so the future.
Let's see if that continues.
Well, and Mark, I can remember us laughing at BP when that was chosen by Hugh as well, and that's now moved into the top 20. It's only been picked 4 times, but it is worth $6,000. So that's moving much better than I think anybody expected when it was chosen for the portfolio.
Yeah, and in fact, I ran into the presentation where he did that. And for those of you that are joining us or not as familiar with Hugh, he started off his BP presentation with video of the leaking valve at the bottom of the Gulf of Mexico.
Yeah.
And it was, he basically finds, he calls them loathed stocks, Loath. And it works out. If you find a company that can recover, it can really work out. All right, so let's go ahead and talk about the portfolio itself. Ken, do you want to cover the report card?
Well, sure. We manage the tracking portfolio based on a manifest dashboard, and that's what you're looking at right now is a dashboard. All those numbers on top are explainable, and we can tell you where they're coming from. They're based on analyst consensus numbers, and we're consulting quite a few different sources to get those numbers and to develop them into a quality rating. The database right now has an average stock return of about 7%. I'm way up in the upper right-hand corner of the slide. That's called MIPAR, Manifest Investing Potential Annualized Return of about 7% for an average stock, and we're aiming to beat the market. We're confident that if George Nicholson were with us today, that he'd be saying, rather than that giving us that 115% goal, he'd be saying, just try to beat the market by 5 points. 15 is beating an average market. The market that we're in right now doesn't have as much return as the average market has had previously. So instead of that 10% return, we're looking at maybe 7% for an average stock. So we're aiming at 12 to 17%. You do a weighted average of the par values for the stocks that we're holding, and our par value is about 11.3. We'd love that to get a little bit higher. It's a good solid B. It's beating the market by 4.3%, so there's nothing to sneeze at there. But at the same time, we'd like to move that up if we could. Quality is great. Growth is a little bit anemic. We'd like sales growth to maybe be in the 11.5, even 12% range, because you're not going to move par to higher levels unless you keep your growth at a higher level. Many of you with portfolios full of very large companies where the portfolio has a sales growth rate of about 7 or 8%, find it very difficult to move the portfolio par, even including dividend, anywhere up above 7, 8, 9%. So you need those medium-sized growing companies and those small growth companies to give you a little bit more total sales growth. I'm looking at financial strength and EPS stability. The clubs that I'm in set the goals for those two at 80. So financial strength is great for this portfolio. We have a number of stocks that maybe aren't quite as EPS stable as some of the good old-fashioned up straight and parallels that we like to focus on. But 73 is not a terrible EPS stability number as well. I'm assuming these are the 5 stocks from the bottom of our list, Mark. Am I right?
That's correct. These are the ones on the proverbial hot seat. And in fact, I'm going to encourage us to let go of Teva tonight. I think we give Neogen a pass. It's at a 3.9% return. We could take a little bit closer look, but I think we want to audit that one a little more carefully. Kim is suggesting we'll sell Sirius. We'll take a look at that in a minute. And then I'm looking at Kroger. We've had a heck of a good run with Kroger. The par is down a little bit lower. It's also at the lower end on the growth side, so that's mine. I picked it. So $1,000 is up 27%. I'm going to request that I be allowed to take the money and run on that one too. So
well, I could agree with you, Mark, that we keep Neogen, and I'd like to keep. I know First Financial is mine. At least one of the picks for it is mine. I'd like to keep it in the portfolio as well. I just think that bank stocks are not valued the way they should be valued at the moment. And I think as interest rates start to rise, analysts are going to have a change of opinion, maybe en masse, about what they think about banks, especially regional banks. I like the growth in Neogen at 12.7. It does have a hefty PE attached to it, but I agree it's a core holding. And for a core holding, I think we'd like to wait until that par approaches money market returns. I do know that money market now probably is over 1%. It hasn't been that high in 10, 12 years, but I do think it's beginning to grow a little bit right now. I'm actually getting interest on some of my brokerage accounts now that have a little bit of weight to them. They're as much as a quarter or 30 cents now instead of the 1 or 2 pennies that I was getting a couple years ago. So I could agree to get rid of Teva, Sirius, and Kroger without any problems.
yeah, and I think it's also an opportunity with a company like Neogen to reinforce George Nicholson's admonition that anytime you're dealing with a double-digit growth company, especially one that's perhaps even up in the 15 to 20% range, fairly early stage, he always insisted that you be slow to sell it, even when you're trying to make the portfolio better. Give it a chance. Sometimes it takes the analysts a while to catch up with a company like that. We certainly see that in a lot of the value line work. So I think keeping it a little bit longer and making sure, of course, watching for any threat to up straight and parallel, because it certainly has that. And I don't know, Hugh, have you been watching any of the buyback stuff with bank stocks that's being kicked around? I mean, Barron's had a big article about it this weekend. Go ahead.
Yeah, I did take a look. I find it really interesting because on one hand, you wonder why they didn't do this years ago, right? Of course, they didn't have the cash, but it's always good for investors. And if interest rates keep going up, and they will, then bank stocks always benefit. And I'm not worried at all about, the mortgage market crashing or anything like that. I don't think that'll be an issue. It certainly will slow down as interest rates increase. But it's not going to be a problem because interest rates only increase when the economy is doing better.
Yeah, I just get this feeling that a lot of the banking stocks have a pretty good boost to them. So
yeah.
Here, I wanted to share this comment from Kim Kaching Butcher, who sent along the comment that just today, Liberty Sirius announced that they were no longer going to pursue iHeartRadio, and she thinks that that's enough of a reason to take the money and run. This is up about 20% from the night that she and the audience picked it. So she basically wants to watch some of the engineering going on by John Malone and the Liberty family of companies and watch for an opportunity in there. So we'll just leave the slide. You can read it. but she's basically saying close out that position, which is only about 6 or 7 months old, but again, it's picked up 10 to 20% in a market that's been relatively flat. And then just to reinforce the Kroger thing, it was picked several months ago. It's up significantly, outperforming the market by several percentage points. And it was just a real nice opportunity. This is a very high quality grocery company that, again, not exciting growth, just a undervalued opportunity, and certainly not one that we're wedded to in any way. Very steady story. Again, watch on that depiction of the net margin, the profitability for the company. Make sure you take the scale of that graph into consideration. It's basically flat at 1.5%. And under current conditions, it's gone from upper double-digit returns now down to lower single-digit returns. So I'm just going to argue for walking away and watching for the next opportunity. Any questions or comments on that? Are you happy, Ken?
I'm happy if we're getting rid of those three. Mark?
Okay. Well, I'll go ahead and take us into the stock selections then. What I'd like to do is start with kind of a Sweet 16. These are some stocks that are, again, I was kind of inspired to do this after the market had gone down for 8 or 9 straight days here a few days ago. By the way, it's the first time it's done that in decades. I wanted to go shopping for some stocks that were relatively high quality with fairly decent return forecasts. And I also wanted to go and look for some that were being punished by Wall Street. And the way that you measure that type of sentiment is using something called the Relative Strength Index. And again, this is kind of a form of charting. All I'm trying to do is flag companies that are getting beaten up by the rhinos or the analysts. And that's the column that you see here. Companies that are down around a relative strength index of 30. And we see some companies that we know have been kind of in the crosshairs, like Starbucks with the resignation of Howard Schultz. And all the way down the list, there are some companies. The other thing that somewhat naturally happens under these conditions is then we also keep track of how close are they to the 52-week low, as Hugh often will do. And you can see that any company below 20 generally will catch his attention. If it's a company that he's vetted and is somewhat that he's paying attention to, this is a lot of companies trading near their 52-week low. Value Line also regards a number of these to have fairly decent long-term prospects. And you can see by the Morningstar price to value and the analyst consensus, and for that matter, the S&P price to fair value, their long-term expectations for many of these companies, anything under 100% is a potential discount, a stock that could be on sale. And you look at those 1-year returns expected from the outside. I'm very comfortable shopping with some of these. I'm not comfortable with all the companies, but I am comfortable shopping in this list. The one that really kind of reaches out and grabs me is one of our favorites. And we're going to talk about Universal Display. This is one that the analysts are just going hog wild crazy in a negative way. And you can see that right here. They think it's tremendously overpriced, even at $80 a share. I think I disagree, and that's what we're going to talk about here for a few minutes. What's interesting is they also see a pretty good upside over the next year with this 81% potential gain in the next 12 months or so. So I'm not sure, I think I want to check their math, but that really does kind of grab me. The company is one that many of us are familiar with, Universal Display, OLED. We'll talk about what they do in a second, but it's a relatively early stage company. You can see there's no earnings pre-2011 or almost down close to zero. And a little bit of erratic sales, a few plateaus in there, some dips. There's a definite dip in expectations for earnings in 2018. That has put tremendous pressure on the stock price. That's the reason for what's currently going on. You can see that the stock price also plateaued back in this time frame when earnings misbehaved. And again, we know or believe that stock prices ultimately follow that earnings line. So when we see this type of situation expected for the company, even when it's getting beaten up by the analysts, we like that, and we see the potential for a future situation which could be fairly good. This is a company that back in April 2014, Ken and I both independently selected for one of our roundtable sessions, and the audience thirded the vote. So we put $3,000 into OLED back in April 2014, and that is now worth $9,374. That's the bad news, or the good news. The bad news is it used to be worth $20,000. Even after that price drop, though, you can see we're actually doing fairly well versus the market, and we're still beating the market by 22% percentage points annualized over that time frame. What do they make? Just like the ticker symbol says, OLED. That stands for Organic Light Emitting Diode, and they just work with a whole bunch of people, including Apple, other companies like LG, that sort of thing. They make these displays for phones, displays for computers, tablets, laptops, that sort of thing. But you can see that the price drop here during calendar 2018 is nothing to write home about. Many of us have felt that. In fact, you can actually go back and listen to our remarks back during that peak where we wondered about implementing a trailing stop limit order and maybe protecting ourselves a little bit against this sort of thing. We didn't do that. And, perhaps we should have, but in any event, I think this is sort of the opportunity to take a company that, a lot of times we'll buy a company at 20, watch it go to 200 and wonder, well, how am I ever going to accumulate any more? I think it's an accumulation opportunity. And here's why. This is the situation faced by the company. Apple is threatening somewhere in that fantastic spaceship-like building to secretly work on its own display screens. And this has been bothering the company for much of this calendar year. And they claim that they're working on screens that'll be better, at least hypothetically or theoretically or secretly better. And obviously, if that happens, it's going to impact the industry. And the analysts obviously think that it's going to impact it quite a bit. But again, keep in mind that these guys work with a lot of people, not just Apple. Apple's a significant and a material part of their business, but it's not the only place that they serve as a client. They serve all of these people making this type of stuff. And the other thing that's probably even more significant or more important for this company going forward, because we want to think about this as a longer term opportunity, is the fact that they're in all this other stuff. Curved screens and electronic stuff that can actually be immersed in liquid without impairing it, and all these different devices. My wife wears an Apple Watch. I never thought I'd see that happen. But a lot of these products and things that they're working on with people with Apple and beyond Apple, they are really good at, and these are actually even more profitable than the smartphones that have been a little bit sluggish and causing some of the consternation. So they do a lot of stuff. A lot of this stuff is actually even more profitable, and we'll see why the impact of that here in a minute. But just a couple of days ago, this is actually from a report from Fool.com where they talk about the situation and gives you a little bit of a overview of all that's going on. Well, Apple reported that they've scrapped any plans to abandon these guys for the next year or two. Just a few days ago, and for some reason, I don't understand it. The rhinos have not caught on to this at all. I do want to dig into this a little bit deeper and understand some of the components of what's going on, but this is just weird. There's many people that think that we're going to see a pretty good bounce back in the company, especially if this is somehow formalized and documented. You can actually go to I got those slides from the public or investor relations website at Universal Display, and there are some commentaries there. But here's what we're basically looking at. End of the calendar year 2017, the Value Line report with the company trading up at almost $200 a share. The projected annual return had actually dipped down and was approaching these levels that you see here, relatively low levels over the last several years. So that's why we were talking about, do we need to protect ourselves? In hindsight, we probably should have. But with the stock price cut basically in half, and really the fundamental position not dramatically different. I mean, we picked it back in April 2014, back here during pretty close to a peak in the return forecast. Not much has really changed. We're looking for upper double digits or upper teens when it comes to the sales growth forecast. We're still looking for pretty decent margin characteristics, And if nothing else, again, the analysts seem to be kind of inconsistent about this. The value line has them at a 25, but in general, the analyst community has them at a longer term price PE ratio of 30-ish or so. So what we're basically looking at is, if this stuff does come to fruition, and if the Apple thing isn't a fatal situation, they are actually back at very attractive, I would say, accumulation type levels for their return forecast. And lo and behold, they have steadily actually been increasing, improving their quality over time. These are all things that we find fairly attractive for a situation. And I think as a long-term investor, I think we are presented with an accumulation opportunity, considering that we hadn't sold it. It would have been really cool if we had sold it and used that money to buy back twice as many shares. But in this case, I think we just press forward, add it to the tracking portfolio, and hope that all of their relationships remain intact. And I think it's got a bright future going forward in an area where a lot of people are buying product from them. So I'm going to go ahead and make it a fourth time selection for OLED in the portfolio, and encourage the audience to scratch their heads about that when they get to vote. All right. So with that, we'll switch and go with Ken for BECN Roofing Supply. Ken, are you still there?
Yeah, can you hear me now, Mark?
I can hear you now.
Okay, I had muted myself and forgot about it. We're going to go with a little bit more mundane product, one that's easily understood by everybody, BECN Roofing Supply. Here's the front page of their investors relation section of their webpage. It's a really dense investor relations webpage. There is all kinds of material. I could have studied this stock all afternoon and still not completed the reading just on their own website. So if you're interested in this company, I urge you to move to their website and go to their investor relations section and start to look at some of the things that are available. Next slide, please, Mark. They are North America's largest publicly traded roofing distributor, and they're number 2, 3, or 4 in almost any of the markets that you look at and in almost any of the product lines that you look at. They make commercial roofing products, residential roofing products, and then complementary building products, which would include the things listed such as siding and windows and decking to go along with the roofing. But asphalt shingles on a new roof is their basic bread and butter business. You'll find the acronym R&R all over their pages in their website, on their investor relations website. And the problem is they don't even tell you what R&R is until about 30 pages in. Stands for rebuild and remodel. And next slide, please, Mark. If you look real closely, you'll see that the company has a pretty wide footprint in the United States and in Canada. A lot of in the Northeast, a lot of building in Florida, Texas, and then a nice smattering along the West Coast as well. 550 different locations, 3,000 trucks, and this number is growing at a double-digit rate as they build more centers and as they make acquisitions. Next slide, please. BECN's overview, again, the largest publicly traded roofing supply company in the world. And you can get a rough idea if you read through this slide. I'm not going to read it for you, but you probably have seen BECN and its product line in your own neighborhood and didn't even recognize the company because they're branded with all different types of brands, and their materials are not only used by their own stores to do the rebuilding and remodeling, but they're also used by independent third parties when they're putting on new roofs or siding or windows or doors or all the other things that go along with rebuilding and remodeling. Next slide, please. They have a growth strategy that's pretty clear. They will grow their business in the same store branches, but they also plan to open new branches. So that's their organic growth. And they're opening new branches at about a 10% rate, which I think is a pretty decent clip for new stores, considering that this is a fairly mature business. They do make a lot of acquisition, and they have a stellar track record of folding those acquisitions right into the company culture and keeping things moving without very many glitches to affect what's happening. And then they also have a lot of market growth. The R&R, there's that acronym again, is about 70 to 75% of their sales. So a lot of what they're doing is on buildings that are already in existence. They're either rebuilding the building or or remodeling the building. And the trends in this area are very, very favorable. With a good economy, people are much more likely to put on a new roof than they would be if the economy were shaking and they were trying to pinch pennies a little bit. Inflation also tends to make it easier for people to afford a roof. The low inflation rates that we've dealt with for many, many years now. Next slide, please. They made two large acquisitions in the last 2 years. They bought Allied Building Supply, and that became additive immediately to their bottom line, both in numbers of stores and in revenues. And prior to that, in 2016, they bought a company called RSG. Both these companies overlapped almost entirely with the kinds of business that BECN was doing, except that they represented different geographies, different geographical footprints, and Allied also brought a large list of additive products to the table that were being sold at fairly high margins, higher than BECN's traditional margins were for expectation. Next slide, please. There's been a recovery in residential roofing. A lot of storms impacted the geographic footprint where BECN has a large amount of business. The storms in the southeast, especially in Florida, and then those in Texas last year, led to a lot of demand for new roofs, for new siding, for new windows. The new construction numbers are fairly decent. They're not as high as you might expect, but they are fairly decent and expected to continue. And you can see by the graphs that a lot of their business, the red portion of the line, is the R&R, the rebuild and refurbish kind of business, and that's in re-roofing, where their huge part of their business lies. Next slide, please. You can see the store growth happening pretty quickly. There's that 51 stores on about a 500 store base. There's that 10% number I was talking about. In addition, their RSG acquisition brought them 22 brand new stores, and their Allied acquisition brought them 30 brand new stores. So there's 103 brand new stores from 2012 to 2017. That's fairly decent growth. And notice the increase in sales as the numbers of stores increase as well. The stores aren't all alike. They don't all feature all of the platforms that BECN sells, but they can be converted to add different platforms as those platforms demand an audience, as they demand a clientele. The greenfield activity is balanced with mergers and acquisitions, so that they're trying to grow organically, but they're not depending entirely on organic growth. Next slide. BECN happens to be a Nicholson triple play stock. Three things have to be necessary for a triple play. You need an elevated potential return. The way that Nicholson remarked about it was a depressed stock price. My interpretation of that is when I'm looking at double-digit total returns for a stock in value line, I think that I'm talking about a depressed stock price, and Value Line is calling for a total appreciation, total return of 31% annualized at the high side, 18% at the low side. So that's the first leg of the triple play. The second leg is that there has to be room for PE expansion. The most recent quarter was a problem for BECN in two ways. Number one, they had acquisition costs from the large acquisition that they made, and those were written off in the second quarter. But on top of that, their business was impacted by the cold, the snow, and the hurricanes. Value Line and the other analysts that cover this company expect that most of that business that was slowed down because of the cold and because of the hurricanes will eventually be booked by the company by the end of this fiscal year, so that what was to be business in the second quarter for them, they do not run with the fiscal year matching the calendar, but what was to be business will be transferred to the third or even the fourth quarter, and that should point to some PE expansion. Right now, a PE of around 13. Value Line is suggesting that more normal PE is around 18. 3 to 5 years from now, there's that PE expansion. They're also making a real strong effort to raise their margins. And if you raise your margins, then you raise your profit. And if you look at the net profit numbers for the last 7 or 8 years and then compare them to where Value Line thinks those numbers might be, Value Line is expecting that those net profit numbers should more than double as the company completes the acquisitions that it's made, continues to make acquisition, and continues to move to products that have higher margins attached to them. So, depressed stock price, room for PE expansion, room for margin or net profit margin expansion. All three of them seem to be there, so that's a triple play. Value Line is suggesting that revenues will grow at about 10% going forward. Earnings may be around 26%. I know that's a huge disconnect between revenue and earnings, and it can't go on forever. But for the next 3 to 5 years, Value Line thinks it's potentially possible to make that happen. When I did my analysis, I did not put that big of a gap in there. I was much more conservative on the earnings growth. If you'll go to the next slide, Mark. Manifest Investing, remember, these aren't Mark's numbers, these are analyst numbers. Manifest is suggesting that sales might grow at about 13.5%. That's close enough to Value Line for my purposes. Next slide again, Mark. I looked at the Chronicle, and BECN is trading at a 5-year historic number that would give me a par way higher than any other par. I'm looking at the red line, folks, and the red line is higher at the end of last month than it has been for the last 5 years. I'm also looking at the blue line, and I love that this company has moved its quality up to around 60 now, and 60 is good, solid quality. It's not the excellent that I normally shop in, but the quality is high. It's in the second quintile, and I'll take that for some of the stocks that I own. Next slide, please. Here's the visual analysis. I'm looking at the margins. A company like BECN or any other building supply company operates on fairly thin profit margins. You can see those numbers in the first line at the bottom down there. Return on equity, pretty consistent. Fairly decent debt. And they've pledged that that debt is going to move to under 20% debt to equity, debt to capital, excuse me, by the time that the 2019 fiscal year is over. So I'm relatively pleased with the numbers. I think I'm looking it up straight and parallel, and I think that one second quarter number, which includes a very, very large acquisition one-time only charge, and then has all the impact from the weather in it. The second quarter is always the worst quarter for this company, and all the other quarters tend to be profitable, and Value Line suggests that what they lost in this quarter will be made up in the third and fourth quarter for their particular business going forward. I think I have one more slide, Mark. Yeah, when I did the final analysis, I'm getting it a buy. My project return about 18.6. I think that Value Line's low total return was somewhere around 18, and I think Mark's par value that he calculated was somewhere around 18 or 19 as well. They're all clustering really tightly for me, so I think it's a fairly decent analysis. I like the idea of moving into the building industry, but not jumping in with both feet on new builds, but rather looking at a product that can be used not only for building new homes and new structures, but for rebuilding and repairing existing structures. So I'm offering a position in BECN Roofing, BECN.
Very cool. Got to take a closer look at that one myself. All right, let's go ahead and press on to another one of Hugh's favorite playgrounds, Bristol-Myers Squibb.
Oh, good. Thank you. Everyone can hear me all right, I'm hoping.
Yeah, you're coming through loud and clear, Hugh.
Perfect. So we're going to look at Bristol-Myers Squibb. As everyone knows, it's a major pharmaceutical company, one of the legacy companies. It's been around for over 100 years, headquartered in New York. The very interesting thing to me about this company is that if you leave aside the acquisitions that it's made, it probably hasn't developed a worthwhile in-house drug itself in about 40 years. And that comment alone tells you a lot about the way major pharmaceutical companies work today. They in-license, they acquire smaller companies that have assumed a lot of risk in the early development stage, and they buy those and they market them. Just to a greater or lesser extent, major pharma is no longer responsible for the lion's share of discovery, certainly in the small molecule sphere. That has been outsourced lock, stock, and barrel to emerging companies. And these big companies are really good at marketing drugs. They can take a drug which a smaller company would squander and make it into something significant. And you contrast that with some of the companies that are in the large molecule space, and we'll talk about those in a second, because Bristol-Myers Squibb is certainly merging into a large molecule company. It acquired about 10 years ago a company called Medirex, and its lead product, it comes from that acquisition. But the stellar name in this arena would be Amgen, that has 9 drugs, each of them worth over $1 billion. Each is a major blockbuster, and that's kind of unheard of, but that's the large molecule space, a little bit different. So we're going to take a look at Bristol-Myers Squibb, and if we move on to the next slide, I'll just let you know that my selection process really hasn't changed. I look for 52-week lows of quality companies, and I like bad news, because I think bad news for a quality company has the positive, it has the benefit of being temporary often. And company will eventually, as long as the earnings engine is intact, it will eventually bounce back. If I'm following the company already, I really am seduced into buying more of it. If it's a new company and I'm not aware of it, that takes work. And I'm not saying I'm lazy. I'll leave that for you to say. But it's just not very tempting to me to learn a whole brand new industry. I'm very fond, too, of mentioning that one of my favorite things to do, and how I got dragged in to some extent into analyzing biotech companies and technology in general, is that when you have a company that doesn't have earnings, and I may, if anyone has a good memory, have presented 1 or 2 of those fleetingly in the past, then you really have to get into the nuts and bolts of how the company works. I think it forces you to pull up the hood a bit more and dig into that engine. So it has that benefit. However, having said that, we all know that it's not a good idea to add such companies to your portfolio in any generous amount. If anything, they should be very sparing, because that way you'll see the upside a lot more dramatically. Think of Amazon with just 2 purchases and it's up in the top 10. Then if you buy a whole lot, there's just downside risk waiting for you to happen. So all else being equal, I'll buy what I bought before, and I had already bought Bristol-Myers Squibb a couple of times, so I'm just going to add more of that to the portfolio. So moving on, Bristol-Myers Squibb, it's a legacy pharmaceutical company. It's about the same size as, say, Eli Lilly. So it's not as big as Pfizer or Merck or one of these guys, but it's large. It's an international brand, and it's had a relatively stable history, although the stock prices, I'll show, has gone all over the place. It has acquired a lot of companies. When you go back into its history, there probably are upwards of 100 companies that it has acquired over its lifetime. Clearly, they're all much smaller at the time than BMS, but they are contributors to the growth of this company. The dividend yield, it's a nice closing in on 3%, and because there's certain volatility associated with pharma companies in general and BMS in particular, it does give on a fairly frequent basis good buying opportunities. There's bad news that hits this company periodically. So let's move on. Where do I find these 52-week lows? One very good site is gurufocus.com. They have a screening tool. Don't click the orange buttons on the top because they'll try to sell you something. But if you click on the drop-down menus below that, you can see stocks within over on the left-hand side. If you move across to the right, you can restrict the selection to North America, or you can look at all countries if you want. I've only looked at S&P companies in this screen. I have excluded over-the-counter stocks, and I haven't touched predictability, which is a focus on how predictable this company is over time. It's subjective, so I don't use that tool at all. But if we move on to the next slide, you can see that Bristol-Myers Squibb came up in the very first screen. All right, now I cannot. Oh, it's right down at the bottom, and it's below such stalwarts such as Gilead, which isn't doing well for understandable reasons that we'll touch on in a minute, and Southwest Airlines is languishing a little bit as well. But it's a very good screen, and I look at it maybe 2 or 3 times a week just to see what's going on. So we skip on to the next slide. We'll have to say right at the get-go that price alone is not a reason to buy a company, and in fact, if anything, it should never be a reason to buy a company, except if you're screening for low prices. But that's only a filter before you get into the nuts and bolts of how a company's performing. And if we look at how it's done in the last few years, we can see it's certainly hurting right now. This goes from 2001 through 2018. It had a very nice performance way back. It languished just like Microsoft for 10 years in the aughties and has since done a lot better. But if you move on to the next slide, you can see Yahoo, which reports way back into early 93, which is when I started buying this company. It had a beautiful run up to the almost the dot-com bubble, the end of the dot-com bubble, and then it languished thereafter because it had an enormous amount of patents expiring, and you can see that precipitous drop that occurred in 2002 as a result. It's on the way back now. So we move on. By the way, it's a very different company than it was 20 years ago. 20, 15 years ago, this was a small molecule company. Molecules such as, say, aspirin or Lipitor, versus proteins, the kinds of things that Amgen will make and sell. So just to reiterate, the stock price alone isn't a reason to buy, but it's something that I find very seductive. And the fact of the matter is that the market, be it the market for Bristol-Myers Squibb stock or the market overall, is an argument about the future. And because it's unknowable, there are a multitude of opinions about what's going to happen, some optimistic, some pessimistic. And when there are more pessimists around than optimists, prices tend to fall, and vice versa, of course, when people are sanguine or very happy about the future. I tend to get a bit nervous when people are cheering and happy because they did the price up and a good time to own, but not a good time to buy. If it's a solid company with nice earnings, when it's a good time to buy, it's not a great time to own. But I'm doing this for the future, as I say, so buying cheap is the way to go. After I found a company that has an attractive stock price, then the work begins. Then you dig into the fundamentals to see if it's worth buying. And for many of us, we have a list of companies that we screen regularly, so we know the answer to this question in advance, but it's always good to double check. And for this, we'll just take a cursory look at some of the recent highlights of what's going on at BMS, Bristol-Myers Squibb. It's confusing that the ticker symbol is BMY, but everyone calls it BMS. At least by everyone, I mean me right now. So the overall market surprised me. I hadn't looked at this in a number of years from a top-down perspective, but it's over $1 trillion. This is the pharmaceutical market, not the healthcare market alone. The healthcare market is much larger. And the global growth is in oncology, in autoimmune, and in anti-infectives. And by anti-infectives, really, they're antivirals. That's what the growth is. It's interesting that one of the biggest infectives that's out there comes from mosquitoes. The mosquito is the animal that kills more humans than everyone else. I don't know if you knew that. Maybe other humans kill more humans, but let's not consider them. Let's look at the humble mosquito going around killing people, but anti-infectives in general, targeting what it's trying to dump into our bloodstream. And for BMS, well, sales are going to slow this year, 4.4% overall, compared to 6.9% growth in 2017. And part of that has got to do with the fact that Gilead came in and basically shot 4 of its promising drugs dead. And I'll show you that in a second. The first quarter earnings overall were robust. Just look at its lead franchises alone, they did a good job. And BMS has provided, for a change, strong guidance for the future. And right now, at least, patent expirations aren't an issue. When a company has a patent, it can sell a specific drug without competition. No one can make a generic version of that. But once generics come along, there is immediate and catastrophic price erosion. That has not happened here. For its lead drugs, its portfolio looks good, and I showed you earlier with the price drop in 2000 to 2002, what happens when patent expiration really takes hold of the company's portfolio. Okay, let's jump on. It manages its debt well. It has good gross and net profit margins compared to other pharmaceutical companies, and it has quite a strong pipeline. We'll look at that in just a second, with an interesting mix of small and large molecules. I'll touch on that in a second as well. So let's jump on to the next slide. And we're going to look at the pipeline, and just by way of background, just some terminology, just to bring you up to speed. When we're talking about something that's preclinical, these are experiments that are done in glassware, they're computer simulations, or they're done in live animals, ultimately live animals before they go into humans. So in vitro, in silico, and in vivo studies happen before you can apply to do a clinical trial or to do experiments, basically, in humans. And clinical trials are generally divided into 3 areas. In phase 1, you have a small trial to measure safety. So you look at volunteers that are healthy and don't have any kind of illness, and you can just see if the drug impacts in a detrimental way the major organs in the body. And by the way, they do animal tests. And what they generally do is they find out at what dose the drug starts to cause harm. And for human trials, they back off that by 99%. So it's rare, it's not unheard of, but it's rare for a bad side effect to occur in an early clinical trial. In phase 2, they will do more safety and a little bit of efficacy work, but they're primarily looking at dosing studies, how much material they can put in for a good effect and without having any detrimental effect on the body. And there could be 100 or 200 patients involved in this trial. And a pivotal phase 2 trial is one where they're actually looking at efficacy in detail. It's like a small phase 3 trial, if you will. In phase 3, well, you want to mirror the market overall. In phase 2, you want people with the illness and nothing more complicating than that. So hopefully they're not taking treatment for anything else, because you just want to look at the effect of your drug on that indication and nothing else. And so in phase 3, what you want to mirror what the population overall is doing. And there could be thousands of patients in the phase 3. saw recently, 10 years ago, Merck lost the competing drug to Celebrex, perhaps because the clinical trials that they did were not powerful enough. They couldn't dig out small problems that occurred in very few patients, and that only happened when the drug went to market. And of course, at that point, the drug got pulled. But by and large, you try to power the trial by as much as you can, and within reason. And the FDA is, for certain types of drugs, is very insistent that you have special trials to make sure that the cardiovascular system is intact and so forth. If there's any suspicion that the mechanism of action could damage anything else in the body. The trials are successful, you submit a new drug application to, in the case of the US, the Food and Drug Administration, and 6 to 12 months later, you'll get some report back from the agency as to whether or not you got marketed. So we skip on to the next slide. I just want to do more definitions. Basically, a drug is a poison designed to interfere with the biological process, targeting more often than not a protein, which is a large molecule. We often call it meat if you haven't had dinner yet, but that's full of proteins. But the proteins in the body that specifically do some chemistry are often called enzymes. They catalyze or encourage certain reactions to happen, and sometimes you want to shut those down. The other thing you're going to see is a brand name as opposed to the generic name. Drugs are always given two names. The brand name is owned by the company. It can be trademarked and held for 75 years or so, and the generic name is the one which competitors will sell the drug when it goes off patent. We look at the various clinical stages or phases and the compound type, whether it's a small molecule such as aspirin or a large molecule, and that could be insulin, an antibody, or something like that. So let's move on. And I like this slide. I pulled it off the web. I should have given the source. I forgot to do that. But it just shows the scale. If you look at the line from left to right where it says 1, that's the size of glucose, a small sugar molecule. 10 times larger, you've got an antibody. 100 times, you've got a virus. 1,000 times a bacterium, and 10,000 to 100,000 a cell. In this case, they're showing a cancer cell. And I find it interesting, 1,000,000 times larger than that, and there's a period that you would write in a piece of paper. So that shows you how much smaller glucose is than a period that you might read on an analyst report today. And for good measure, a tennis ball is thrown in. But on the next slide, it gives maybe a clearer picture. This one came from Amgen, Sensipar, a drug that they've marketed for a number of years now. And you can see that small blue dot in the middle of the screen. There's a kind of a triangle where it's blown up into a circle, so you can see what the molecule looks like, each atom individually, and how small it is compared to what it's glommed onto, a larger molecule or a protein, a biologic as it's generally called. So if we skip on, you're going to hear about receptors when you look at their pipeline. These sit on the outsides of cells. The cell is like a big football. Lots of molecules embedded in the surface. This is an example of the receptor that brings in insulin to do its work into a cell to help gobble up glucose and create energy for that cell. But there are lots of different types of receptors. The cell wants to make sure that it only lets in what it needs. And if something that comes along that it doesn't like, it can call the immune system to go kill it, or it can refuse its entry. So let's move on. And I put all these in because you see them in the pipeline, and I just want at least to give you a 33,000-foot view of what they actually mean. You'll see the word agonist and antagonist a lot, and these have very specific meanings in the pharmacological world. An agonist is something that goes to a receptor that we just talked about in the previous slide, sitting on a cell wall. It goes to the receptor. It occupies it, so it blocks that receptor, and it activates it. Whatever the receptor is supposed to be doing, if the receptor is open the door, open the wall of this cell and let stuff in, that's what it does. If the receptor is, hey cell, it's time for you to die, then the cascade starts and the cell will die. An agonist or an antagonist, on the other hand, just sits there and blocks. It doesn't activate anything. So agonist activates is how you will remember the difference between agonist and antagonist when you see them over and over again in the pharmaceutical world. And then I think finally the last word you'll learn about is an inhibitor, which is on the next slide. And generally it's a molecule, very often a small molecule, that binds to an enzyme. An enzyme is a protein that catalyzes some chemistry or other function in the body, and it binds to the protein and inhibits it. And it's very interesting when you look at large molecules. If you move a bond, or how things are bonded together, by a fraction of a nanometer, you're talking about 10% of a nanometer, it can affect the overall activity of that huge entity, because the small bond change that you make ripples through that molecule and disrupts it. That's how one of these inhibitors works. It just sticks onto an enzyme. It's not looking for a receptor here. Receptors sit on cell walls. This is just a molecule that does some work, and you want to stop it doing that work. So you stick something onto it to mess things up. It's like if you stick two people's hands together. We can still talk in Ireland, but many other cultures are driving into silence. So let's move on to the next slide. And we're going to just quickly go through the pipeline here. I put it all up here because I think it's a good lesson. It's the pipeline's on the website, obviously, and I've divided it into the different therapies, the 4 major therapies that this company looks at, and whether or not they're small or large molecules. And in immunology, or immunosciences, they're calling it here, they have quite a nice pipeline of small molecule drugs in phases 1 and 2, and 2 drugs, which are biologics, came from Netherux, I believe, and they are already marketed, which is the M in the middle, in that little green circle. So these are the franchises in immunology. So they're not close to being marketed yet, the small molecule franchises. And you'll see the word inhibitor in a number of places. This is the kinase inhibitor, BTK, and agonists as well. So skipping along, it has a cardiovascular franchise as well that is almost exclusively small molecule, with 4 drugs still being developed, and 1 drug, Eliquis, which is an anti-clotting drug, marketed, and that they're doing more clinical trial work on this drug as well. And then if we move on to the next one, fibrotic diseases, this is pain, different parts of the body, nerve endings really. Again, it has a breakdown of small and large molecule here, but really very few drugs compared to what's going to happen next, which is cancer or oncology. If we move on to the next slide, we can see these are just the small molecule oncology drugs, and there are 6 of them. Very heavy in phase 1, which is the highest risk, highest rate of failure area, and one that's approaching that's in phase 3 and approaching the point where a new drug application will be filed. And dasatinib is already marketed in cancer. Bricel, we've seen that before. Then we skip on to the next slide. This is where it gets hairy, because the large molecule drugs, there are a lot of them, had to be split up into phase 1. These are biologics or large molecules. There are a bundle of them, as you can see. And then if we move on to the next slide, here's the oncology drugs that are in phase 2 all the way through marketed. It has a very rich pipeline in this area. And the reason that drugs like Yervoy and Opdivo are on this is that they are still doing clinical trials on these drugs to see if they can expand the label to other indications or other types of therapies. And that's important, as we'll show in a second. So we skip on. We can see how they're doing. The middle column, Q1 17, shows how they did in the first quarter of 2017, each of the major drugs that have been launched. And then look what happened in Q1 18. Now, the fact is, Opdivo did really well. It grew by 34%. Yervoy declined, had a competition with a drug that Merck sells. But where you really see decimation is when you go to the antivirals. And you can see that here, in the worst case scenario, a hepatitis C drug dropped by 98%. The reason for much of this has got to do with the fact that companies like Gilead came along and pretty much dominated this market in a very short period of time. They're currently suffering, but they did a phenomenal job. Having lost almost overnight a couple $100 million, BMY Bristol-Myers Squibb more than made up for that with Opdivo jumping 34% from 1.1 billion to 1.5. And yes, while revenues only grew 1%, it's pretty much all attributed to the growth in its cardiovascular and in its oncology franchises. And based on its current activity in the clinic, they should continue to grow. So if you move on, we just, the next slide, you just see how that activity on the previous slide affected their numbers. You can see the cost of goods sold has increased. R&D expenses increased very slightly, whereas the net income, despite bad news on the previous slide and the fact that its earnings before interest and taxes dropped, the net income has actually increased. So we skip along. Opdivo is the drug that dominates the news about BMS and is responsible, at least for the last 2 years, whether the stock price shoots up or drops down. It is an anti-cancer drug. It is a large molecule, a thing called a monoclonal antibody, and it's a checkpoint inhibitor. And basically what it does is it tells a cancer drug, a cancer cell, it is time for you to die. It goes along, attaches itself to it, and basically says, now you must die. Every cell has an auto-destruct button. This drug just activates it. It is currently indicated in metastatic melanoma, which there's no other cure. And it's used in combination with a second drug from Bristol-Myers. But where it shows a lot of promise recently is in lung cancer, non-small cell lung cancer. Seems to work well. And it interrupts the programmed death inhibitor. It's a PD-1 drug. Programmed death is like the self-destruct button. And it's in the off position, and it inhibits it and puts it in the on position. So we skip along to the next slide. Where it faces a lot of competition is with a Merck drug called Keytruda, which you'll see advertised on TV quite a lot. And every time there's some good news about Keytruda, and it's always done in context of what's going on with Opdivo, then the price suffers or else does well, but pretty much recently it's been suffering. And Roche has come in with an autoimmune drug as well for cancer. But there is good news for Opdivo, which is going to be the driver for earnings going forward until the pipeline that I talked about blossoms a little bit more. At ASCO, a cancer meeting, which is a huge thing every year in June, where companies showcase their cancer drugs, it reported very good news in this non-small cell lung cancer trial, where it looks at a specific biomarker. This is something in your body you either have or have not. You have this biomarker and are treated with the drug, then patients apparently respond very well. Merck also announced some good drugs as well, and it quelled what otherwise would have been nice news for Bristol-Myers Squibb, but didn't eradicate it as it did a year or so earlier. Skipping on, I think we're close to wrapping up. The stock is still down, and it's done quite badly. But the recent news has been good. It's getting better. Certainly, the work on lung cancer is very promising. I like the look of its pipeline for the future. You know, phase 1 drugs, there's a 10% chance they will go to market, so you have to take them with a grain of salt. But it has a nice array of promising-looking drugs. And another billion-dollar quarter drug is something that this company will do with. The company itself is moving into large molecules, which have a better rate of approval than small molecules, and oncology is dominating the pipeline for this company. So as long as no one finds a cure for cancer, Bristol-Myers Squibb will be okay. I'm not joking; it will happen at some point. Not now. So I'm going to pick Bristol-Myers Squibb again.
Good stuff. Thanks, Hugh. That's a pretty comprehensive review, and I've got some homework to do tomorrow morning, thanks to you two gentlemen.
Well, I put up the offer there again. I know somebody maybe a year ago asked me, can I go through the drug presentation again? Maybe I should dust that off at some point.
Yeah, and in the notes that accompany the post for this, I'll actually include the links to your FDA presentation also.
Okay.
Good stuff. All right. Well, Ken, I think we are ready for an audience poll.
Are you hearing me, Mark?
Yes, can hear you just fine.
Okay, here we go. I'm launching the poll. Use your mouse or your finger, whatever suits your fancy.
And I'm not just saying this. I think this is one of the tougher choices I've seen in a long time.
We're up to 75% of the people, 80% of the people voting. So even if you're here for the very first time, please vote for your choice. Or if you don't like any of them, vote for none of them. I'm going to try to wait till we get to 90% voting. So we need a few more of you to press those buttons if you possibly can. I'm going to count to 10 in my mind here and close the vote down. And this doesn't happen very often, Mark, but we actually have, I just pressed the wrong button. I'm closing it and I'm sharing the results. And look at that. We have a dead heat between BECN and Universal Display. So
I guess we'll call that
we'll put a 1,000 into both of them, okay?
Sounds good.
All right, and I'm going to hide that right now. And you can go to the next slide then, Mark.
And personally, I dislike cancer so much I would have voted for Hughes.
Hugh, we have a question from Linda, and she'd like to know, is there any time length on these phase trials?
That's a good question. There is not. It really depends on the trial. Some of them can be very short and over within a month. Some last 2 or 3 years. What's called a cardiovascular outcome trial, where you're applying the drug to make sure it doesn't have any detrimental effects in the cardiovascular system. That can last for years. But one of the biggest drags in a trial is recruiting, finding suitable patients to put in the trial, and screening them in if you want them. That can take an ungodly amount of time.
Thank you. Mark, Joe would like us to go back to slide number 3, and he has a question on that slide. And Joe, you asked us to go back to slide 3, but I'm not sure this is the slide 3 you're talking about. Do you have a question, Joe? Oh, he just wanted the info. Okay. All right. So it's there, Joe. You have it, and if you can get this on YouTube also to take a look at it again if you need to. Mark, we don't have any other questions that we're looking at right now. Usually at this point they start pouring in again, but I don't have any hands raised. I don't have any questions in the question box.
Okay.
So we just need to let folks know that the July roundtable will be on July 31st. I'm going to be going to Oklahoma City in mid-August. Mark and Cy will be in Atlanta on the exact same day. We will have an August roundtable, but the date is yet to be chosen. And then in October, Mark is going to Washington, D.C., and I'll be going to Charlotte, North Carolina. So if you're looking for dates where you can talk to either one of us in person, here's our partial calendar through October. If you're in a chapter looking for a program, we're trying to set up dates right now. Now would be a good time to make your request. Our calendar starts to fill real quickly once we get to the 1st of August. So we love to travel, and we'd be glad to talk with you about coming to visit your chapter if it makes sense for both of us to make that happen. I'm getting some. Mark, you have the wrong date for Atlanta again, and the date is the 25th, not the 18th.
Well, I fixed it before.
And I'm getting all kinds of people reminding you that that's the the date for the Georgia Investment Fair, okay?
I fixed it before.
So Mark's gonna, it's
it.
the 25th, folks, not the 18th. I'm going to be in Oklahoma on the 18th, but Mark and Cy will be in the Atlanta Investing Day on the 25th. Oh boy, Oklahoma and Atlanta in August. Okay.
I left it on the 18th so that they could get their extra publicity out by
publicity. Okay, we got it.
Just checking to see that they're paying attention. No, in all seriousness, Cy and I have been talking about, he's going to do the presentation on risk, and I'm going to join him, and we're probably going to lean on Cloonan's book that we talked about a year ago about, what is really risk, and how different is risk for us as a community of investors. And I will tell you, my personal experience over these last few years with how our community regards risk is it's just amazing. It's just phenomenal, and it'll be a whole lot of fun getting together with the mighty Reverend.
Very important topic.
Yeah. Okay. I think we're in good shape then. Hugh, thank you so much, Hugh. We're getting all kinds of nice comments in the question here. People missed you, Hugh, and they really appreciated this presentation. They thought they learned a lot on the idea about pipelines. So we hope we'll see you in a month. And Mark, as always, we couldn't do any of this without your help. So it's greatly appreciated. And I'll talk to you tomorrow sometime about some future dates here, okay?
You bet. Well, thanks, everybody. Glad you enjoyed it.
Thanks a lot, folks, and we'll be talking with you in a month or so.
Thanks
Goodbye for now.
I'll be in touch.
Bye, everyone.